Welcome to News Edge, your sharpest source for daily headlines and deep dives. If you're new here, don't forget to hit that subscribe button and stay ahead of the curve. Let's talk about gold. It's more than just a shiny metal. It's a symbol of wealth, power, and security that has fascinated humanity for thousands of years. Gold is shiny, expensive, and for centuries we've all agreed it's valuable, even though you can't eat it, fuel your car with it, or build a house out of it. Its allure is almost magical, and it's been at the heart of empires, wars, and fortunes. Now imagine your government decides to make gold even pricier. That's what a gold tariff is, an import tax slapped on every ounce of gold crossing the border. Suddenly every bar, coin, or piece of jewelry coming in gets hit with an extra cost. Think of it as a bouncer at the border. You want in? Pay up. No exceptions, no sneaking by. The price of entry just skyrocketed. Usually tariffs are small, annoying but manageable. They're like a cover charge at a club. You grumble, but you pay it and move on. But on that infamous Tuesday, the government dropped a bombshell, a 39% tariff. Not a typo, 39%. That's not a fee. It's a financial earthquake. It's the kind of move that sends shockwaves through every market, every investor, and every business that deals with gold. Suddenly, imported gold costs nearly 40% more overnight. Imagine waking up and finding your savings, your jewelry, or your business inventory just got way more expensive. Why do this? Tariffs are supposed to raise money for the government or protect local industries from foreign competition. Sometimes they're used as bargaining chips in trade wars. But this was more like economic shock therapy, a jolt to the system so big, it left everyone reeling. It wasn't just a tweak, it was a sledgehammer. Every bit of gold trying to enter the country just got a massive price tag. It's like putting a giant "Do Not Enter" sign on the border for gold. Economists everywhere started panicking, because gold isn't just for jewelry, it's a pillar of the global economy. Central banks hold it as a reserve, countries use it to back their currencies, and it's a safe haven in times of crisis. Investors run to it in a crisis. When the world feels unstable, people buy gold. It's the ultimate insurance policy against chaos. It's a symbol of stability, trust, and enduring value. Gold is the anchor when everything else feels like it's drifting. So, taxing it heavily is like taxing oxygen. Sure you can, but everyone's going to feel it. It's a move that hits not just the rich, but anyone who relies on gold's stability. This wasn't just a tax, it was a giant flashing sign. We're either geniuses or we've lost our minds. The world was left wondering, is this bold strategy or reckless gamble? The world was about to place its bets, and none of them were good. Uncertainty spread like wildfire, and everyone braced for what would come next. A tariff this size isn't a ripple, it's a tidal wave. It crashes through markets, upends plans, and leaves a trail of confusion and fear. It's the kind of move that makes even calm economists start drawing panic graphs, revising forecasts, and warning of unpredictable consequences. Gold is woven into the fabric of finance, so a tariff here shakes the whole system. It's not just about one country, it's about the entire global network that depends on gold. The government aimed its financial bazooka at gold, and the fallout would be global. Every country, every market, every investor would feel the aftershocks. This wasn't just policy, it was a declaration of economic war on common sense. Businesses, investors, and ordinary people all scrambled to figure out what it meant for them. The 39% tariff was a signal. Brace for impact. The message was clear. Nothing about gold would be business as usual. And the world, watching in disbelief, knew the shockwaves were just beginning. Place your bets, because the gold game had changed forever. The moment the news hit, financial markets lost their minds. The Dow plunged, traders panicked. It was as if a tidal wave of uncertainty crashed over the trading floor, sweeping away any sense of stability. The chaos was instant and overwhelming. The air was thick with fear and frantic phone calls. Desperate voices echoed across offices as people scrambled for answers, trying to make sense of the sudden collapse. Every ring of the phone seemed to bring more bad news. News anchors scrambled to explain the chaos, their faces a mix of shock and excitement. Live broadcasts tried to keep up with the rapidly changing story, but even the experts seemed lost for words. Headlines screamed, "Gold shockwave, markets in freefall." The world watched in disbelief as the story unfolded, each headline more dramatic than the last. Investors dumped stocks, not because companies were bad, but because nobody knew what would happen next. The fear index soared, measuring the raw panic that gripped the markets. Uncertainty was the only certainty. Everyone wanted gold, but gold was now the problem. The very thing people turned to for safety had become the epicenter of the crisis, leaving everyone confused and anxious. It was like running from a fire only to find the exit is also on fire. There was nowhere safe to turn, no easy escape from the turmoil. The safe haven had become a trap. What was once a symbol of security now felt like a prison, locking in fear instead of hope. This wasn't a debate, it was a stampede. People weren't calmly weighing options, they were running for their financial lives, desperate to avoid disaster. Panic spread worldwide. London, Tokyo, Hong Kong, all felt the shock. The crisis didn't respect borders, it leapt from market to market, leaving confusion in its wake. The world's financial systems are so connected that one country's blunder became everyone's crisis. A single decision sent shockwaves through the entire global economy, tying everyone's fate together. This wasn't a sneeze, it was a full-blown seizure. The system convulsed, and the pain was felt everywhere, from boardrooms to living rooms. The first day sent a brutal message. The world thought this gold tariff was a catastrophically bad idea. Leaders scrambled to respond, but the damage was already done, and everyone paid the price. From Wall Street to Main Street, the shock rippled outwards, touching lives and livelihoods everywhere, leaving a trail of worry and loss. How does a 39% tariff hit real life? Like dominoes, it starts with big players and ends at your kitchen table. Gold inside the country becomes scarce and skyrockets in value. Anyone holding gold gets an instant windfall. Businesses that use gold, jewelers, electronics makers, face soaring costs. Your phone, laptop, even your car's computer just got more expensive. Companies pass those costs to you. Grandma's necklace? Worth more if she sells, but buying new jewelry is now a luxury. Traditions like wedding rings become a financial burden. The ripple spreads, electronics, dental work, even medical equipment costs rise. What seemed like a tax on luxury seeps into every corner of the economy. It's a tax on stability, technology, and tradition. One bad policy and everything gets a little sicker. Let's see the fallout up close. When a major economic shock hits, its effects ripple through every layer of society, from the smallest shop to the largest corporation. At the jewelry store, Barry's next gold shipment costs 39% more. The price hike isn't just a number on a screen. It's a real, immediate threat to his livelihood. He raises prices, customers walk out, sales plummet, staff get laid off. A family business teeters on the edge, forced to make impossible choices just to keep the lights on. Multiply Barry's story by thousands of shops nationwide. Each one is a thread in the fabric of local economies now unraveling. Now zoom out to a tech giant, Future Corp. Their microchips need gold. Suddenly, their costs explode, threatening their ability to compete and innovate. They can't stop production, so they pay the tariff and hike prices. The burden gets passed along, affecting not just the company, but everyone who relies on their products. Car makers, hospitals, and everyone down the line pay more. The cost of essential goods and services rises, straining budgets everywhere. Future Corp's global rivals, not facing this tariff, undercut them. Contracts are lost. Layoffs follow. The company's future, and its workers, hangs in the balance. The tariff, meant to help, cripples innovation and competitiveness. Research stalls, and the next big breakthrough is put on hold. It's not just Wall Street feeling the pain, it's every business, every worker, every consumer. The shockwaves reach every corner of the economy. The government's policy didn't just touch gold, it broke the supply chain. Production slows, deliveries stall, and shelves go empty. From engagement rings to MRI machines, everything gets pricier. The cost of living rises, and dreams become harder to reach. The country's own industries are kneecapped. Factories close, jobs disappear, and communities suffer. The ripple effect is relentless. One policy decision sets off a chain reaction that no one can escape. A single tariff, and the damage spreads everywhere. No sector is left untouched, no business immune. The policy meant to protect ends up destroying what it was supposed to save. That's the real cost, measured not just in dollars but in lost opportunities and broken lives. And it's paid by everyone. In the end, the burden falls on ordinary people who never saw it coming. Why would any government do this? Usually it's about money or misguided protectionism. Maybe they want to raise revenue, tax gold, fill the budget, but a huge tariff just stops imports cold. No imports, no revenue. Or maybe they want to help local gold miners, but domestic supply can't meet demand and prices become a bubble. Sometimes it's a political move, trap wealth inside the country or flex in a trade dispute. Whatever the reason, it's desperation, not strategy. The result? A self-inflicted wound that misunderstands how a modern economy works. The logic is flawed, and the consequences are real. The risks of a massive tariff are obvious and immediate. First, market instability, investors panic, assets are dumped, and the economy slows. Higher costs ripple through industries, pushing up prices for everyone. This is cost-push inflation. Things get pricier, people buy less, companies cut jobs. The government's grab for gold ends up shrinking the whole economy. Then comes retaliation. Other countries slap tariffs on your exports. Trade wars erupt. Everyone loses. Most damaging of all, trust evaporates. Businesses and investors lose faith in the government's judgment, investment dries up, and the damage to credibility lasts for years. The economic wounds may heal, but trust is hard to rebuild. One reckless move and confidence is shattered. The price of that mistake lingers for a generation. Make gold too expensive or illegal, and you hand the black market a golden ticket. Smugglers step in, offering gold at a discount. No taxes, just risk. The government's revenue vanishes, replaced by a booming underground trade. Law enforcement costs soar, but smugglers stay ahead. Criminal networks grow richer, using gold profits to fund other crimes. The policy meant to control gold ends up fueling organized crime. Unregulated gold floods in, possibly from conflict zones, possibly fake. In trying to control the market, the government loses all control. A tariff this drastic doesn't just hurt at home, it angers the world. Major gold exporters lose a key market, diplomatic tensions flare, the country is condemned, isolated, and seen as unreliable. The global gold market destabilizes, prices swing wildly, and everyone's reserves are affected. Financial instability spreads across borders. Protectionism like this undermines decades of global cooperation. One country's blunder can unravel the whole system. It's a masterclass in how to lose friends and alienate the planet. What's the lesson? Simple solutions to complex problems almost always backfire. The economy isn't a machine, it's an ecosystem. Blunt policies cause chaos. Stability and predictability are priceless. Once trust is lost, it's hard to regain. Investors remember, and the country's risk profile is forever changed. The law of unintended consequences is real. A tax meant for revenue brings panic, black markets, and trade wars. Policymakers must think beyond the first impact. Every action has ripples. The gold tariff is a cautionary tale. Tariffs aren't magic wands, they're dangerous tools. Prosperity comes from stable policies and open trade, not economic walls. Let's hope this lesson sticks, because history shows we're quick to forget. And next time, maybe don't bet your gold on government wisdom.